Hello, and thank you for joining us today for our ePractice Manager webinar with our special guest, Elliott Tracy from Jones Roth CPA Group. Today, Elliott will be speaking about some tax credits doctors can use and receive benefit from. Elliott Tracy is a partner and a key member of Jones Roth Healthcare's dental team. He specializes in providing dental and medical practice owners with practice benchmarking, cash flow planning, business strategy, and tax planning. Welcome back, Elliott. It is fantastic to have you.
Yeah, thank you, Sarah, so much. I appreciate being on again with you guys. I know we've done about 4 or 5 of these, I feel like, over the last year or so. It's been a lot of fun, and I really do enjoy speaking with everybody. So let's jump right in. Tax credits, huge topic right now for dentists, because I know everybody's really trying to maximize what opportunities are there. And I think there's been times in the past where maybe it's just been overlooked inadvertently. And so I have a few of those that are items that have been overlooked, but more importantly, right now we have some more time-sensitive credits that I wanted to spend some specific time talking about. So that's really the objective for today, is understanding what these tax credits are that are available to dentists. And these are just a few of them, some of the more common ones that we see pop up, and then a few miscellaneous ones. So let's start with that. So first off, we are going to start with some miscellaneous tax credits, and then we're going to spend some time talking about what has been a really hot topic in research and development credits. And then we'll finish up with the employee retention credit, which is something that's come specifically out of this pandemic. And it goes back to the first quarter of 2020, and it will continue through the end of 2021. So let's jump right in. So miscellaneous, what couple of items come up? So the disabled access credit, this is kind of an interesting one that we do see, and something that many aren't really aware that it's there. And so the best example, there's a 50% tax credit on up to $10,000 in qualifying expenses. And so that's obviously a $5,000 credit. There's some limitations on who can claim that, but where we see this come up quite a bit is, for example, at an office where you create a wheelchair ramp, or maybe you have another feature that makes it more disabled person friendly in some form or fashion, in terms of either widening hallways or creating differences within rooms to accommodate those types of items. That is eligible for this disabled access credit. And so what businesses are eligible? Well, you can't have more than $1 million in revenue or fewer than full-time employees during the prior tax year. And so there's a lot of offices that have fewer than 30 full-time employees and are eligible for this credit as a result of that. So good opportunity, $5,000 each time you have the $10,000 in qualifying expenses. Now with this, you don't get to deduct the $5,000 in expenses, but it's a much better deal to have the credit anyways. Another one, again, this is usually, so both of these are kind of ones that are there more, I'm not going to call it for startup practices, but certainly usually earlier in the stage, except with the disabled access, that could definitely show up later on as well. But the retirement plan startup credit, this is one definitely that is an earlier on. So as a practice gets up and going, the startup of a retirement plan with that. So this credit is, it's a 50% of eligible costs up to the greater of $500 or the lesser of $250 times the number of NHCEs, and that word is non-highly compensated employees. So that's usually not the doctors, and that is not the owners. So $250 times anybody who's not considered highly compensated, or $5,000. So there's definitely, where we've seen this is, usually early on it's the $500 credit because it's a startup, and that's just the eligible costs that are there to do it. But then there's also the potential for a $250 times the non-HCEs, which in that case, maybe you're in year 2 or 3 and just now starting it up. Maybe there's 10 employees. And so there's certainly more of an opportunity at that point to claim this credit at a higher amount other than just the 500, which is generally what we see. The reason we're bringing this up is we don't want anybody to miss out. I know it's not a lot, but it's still something that is missed out on a lot. I see it missed all the time. A couple of additional notes, and then we're going to move on to some other things. So the retirement plan startup credit, it's for those with fewer than 100 employees. You have to have at least one non-highly compensated employee. And then most participants have not received benefits in the past year. So this is not something where you can go from like a simple plan to a 401k and then not have it, and then make the change and then have it be different. Okay, let's spend some time on the research and development credit. Now, this is something that is newer for dental. It's starting to become more popular, but there's a lot of gray area. And gray area in that what there needs to be this elimination of some type of uncertainty. So to be eligible for it, the business, the practice that is trying to claim this credit, like I mentioned, there needs to be an elimination of uncertainty. There needs to be a process of experimentation. Technology needs to be at the core or in the nature of it, and there needs to be a qualified purpose. Now, one of the big examples is the custom design of or for a solution. The easiest example is the creation of a software, of a technology-based software. But for dental, it's a little bit different in that some of the ways you could potentially be eligible is the 3D modeling, the CAD, and items like that, the customization of, specifically we talk about crowns and the items that go into that. Those types of things are potentially eligible. The improvement of a process within the office is something that can also be included as part of a research and development credit. But it really needs to be a improved process and something that is improved. It can't just be new, the same thing, but just new. And that's one real emphasis and kind of the gray area where this comes in. There is certainly the potential, and there's a lot of experts out there that know these rules really, really well and can talk about it at a really high level. And those are the kinds of things you want to keep an eye on. But specifically, there needs to be technology. There needs to be some type of process of experimentation. And really, there's the goal of eliminating uncertainty as part of the process. And that's where you really can have the ability to be eligible for this credit. What type of things qualify for the credit? So specifically, the research qualified research expenses, those are wages that are paid to employees, and that doesn't have to be somebody who's fully dedicated. You can take an allocation of that employee. So maybe someone spends 20% of their time doing an activity that's qualified. That you would take 20% of their wage and other items related to that employee. Supplies are another specific item that they are potentially eligible to be deducted if those supplies are specific to that activity. And then if there are third-party contractor expenses or other things that are paid in relation to it, so software fees, items of that sort, those are also eligible expenses. Now, this credit is calculated a couple of different ways, and this is where it gets really complicated and can be very complicated. Is you have this regular credit, which I said, this is a more complicated process. The credit is in general, I'm kind of using a little bit of vague language intentionally because to walk through all of the different parameters would be really, really I would say far too in depth, but essentially it's 50% of your expenses or 50% of the expenses less this base percentage times an average annual gross receipts. So what does this mean? Usually most dental practices, almost all dental practices I have seen are not using this process. And why are they not? Is because calculating this base percentage that we talked about means going back to when you first started doing this activity. And a lot of times that is in a much older year where there was more vagueness around this process, or not even much older, but even a year that's closed for tax purposes. And there's not the benefit there. There's not the cost benefit of going through the regular calculation versus other methods. And so that's why we're not seeing this a lot. It is there. If it's something where you just started doing this within the last year or two, maybe this is more beneficial for you, but it is a case-by-case basis in all of these situations with R&D and which one is the most advantageous. I mentioned there's another method. So the alternative simplified credit, obviously, this is it. It is what it is. It's exactly what it says it is. And that number is it's a credit of roughly 14% of qualified expenses, and it needs to be increasing year over year. So a lot of times with offices, this is the biggest misnomer is the credit is a kind of a one-time shot. So you get it in the first year when you've got a bunch of these activities, or they choose the most open tax year. And so this case, that's 2000, in this year, if you haven't filed your 2020 return yet, you're looking at 2017 is still open, 18 is open, and 19 is still open. Those are the years for which you can claim this credit. And it's a big shot in that first year. And then if you had more of those expenses in the next couple of years, the credit's still there. It's just the amount that's increased over that item, and you're getting those. So you can see it's far more simplified, much less involved than calculating this base period and doing all of these crazy things that, to us, we don't generally see the cost benefit. The other piece with this too is, so when you take this credit, it's going to add that credit back to income. And at certain limitations, there are times where the adding back of the credit to income doesn't yield the same benefit, or not quite the same benefit that we would want to see. And so there's an option to elect a reduced credit amount. So then it takes 80% of your number, it reduces it by a certain percentage, and then you get a credit on your income tax return based on that reduced credit, while not having to add back the credit to income. And so that's the piece where, as you can see, there's 4 or 5 steps here we've talked about. Is, do you take the regular or not? And how do you calculate the base if you're going to do that? Or if you're not going to do that, let's move to the simplified. You still have to go through that allocation of saying, what's the qualified expenses? So how much of wages are eligible? How much of third-party contractor payments are eligible? If you have somebody come in to provide a service, that's an outside provider. And then supplies are also one of those things. And at what percentage are those supplies eligible? So you can see there's a lot of steps as part of this. Really the biggest thing with it, and why I'm not spending a ton of time actually going through a calculation, is the documentation of why you are eligible and where the eligibility comes from is really the most important thing. It's what creates the most potential audit risk, is not having that documentation and not having it all there to say, if you're questioned on it, why are we eligible? Then, how do you go ahead and calculate the credit and claim that credit when you haven't completely documented how you're eligible? So that's a couple of those big things. A few other things I want to make sure I mention too is there's some specific rules for state purposes. So state income tax purposes, whatever your resident state is, that could also have a little bit of an impact on which credit or whether you decide to go through this calculation, because it is expensive to go through the calculation and to determine how much of a credit you're going to have. It's a very, as you can see, it's an in-depth process. So for example, I'm a resident in the state of Oregon. The state of Oregon has its own credit, but it only allows that credit for corporations. And so you either have to be a C Corp or you have to be an S Corporation. If you're a partnership, that partnership credit will not be passed down to the individuals. A partnership is not allowed to claim it. So a partnership only sees the benefit on the federal level, but not at the state level, versus if you have and most dental practices are generally S corporations. So a lot of cases, this may not be a problem, but at least in our specific example, the S corporation can therefore pass down a certain percentage as the state credit to the individuals. And so you'll get this credit on your personal income tax return. There's been a lot of things over the last, so with the PATH Act from 2015, 16, this credit can now offset the alternative minimum tax, which was something we used to see a lot in previous years. And that's something we haven't seen a whole bunch with these changes of the Tax Cut and Jobs Act in 2018. But if there are changes again to tax law, we could see that shift a little bit. But the PATH Act is something that allows you to take these credits against all forms of tax you have. So again, really complicated, but a lot of things there. Is definitely something I would look into, something to at least ask the question to see if you're eligible and if you have eligible activities, because it is a pretty lucrative credit. I mean, it's, anywhere between 30 to 50%. And it's there's a really a good potential there for a practice. Now, the other credit I wanted to talk about, and this is one that is far more lucrative right now because of the real cash dollars that can be going into a practice's pocket. But the biggest piece of it is it's a finite period of time. We know when it's ending, and we know that it's there, and it's something that you should look at and take advantage of. The employee retention credit came directly out of the CARES Act, passed back in March of 2020. It continued through the end of 2020 that these employee retention credits were available, but then it changed, and it changed with the Consolidated Appropriations Act of 2021. They expanded it, they made changes to it, and we're going to talk about that a little bit because initially, not everybody was eligible. So for 2020, this is a 50% credit on qualifying wages and allocable healthcare costs. So $5,000 eligible, so 50% of up to $10,000, meaning your max credit is $5,000 per employee per year in 2020. So if you had 5 employees, you maxed out all those expenses, that's $25,000 potential for that year. And this is just on employees, it is not on owners. So the owners' wages are not eligible. To be eligible for this credit, you had to have a drop of greater than 50% in revenue, or, so not and, or fully or partially shut down due to government order. This was basically every dental practice from about March 12th through the midway point of either May or June, depending on where you were, or maybe a little bit sooner than that. Again, it all depended on where you were. So that creates some of the complexity of how this credit works. The other, and we'll talk about this here in a minute because there's a really interesting interplay with the Paycheck Protection Program. I know this is all about tax credits, but this credit particularly has an interplay, and we've got to talk about that. Now, for 2021, this credit became far more lucrative. It is now 70% of eligible wages and health costs up to $10,000. And that means you can take $7,000 per employee, but it is a per quarter. And this says it says 14,000 in total. This credit was initially only going to go with the Appropriations Act. It was only going to go through the end of June. This is now going through the end of the year. This has been extended out with most recent tax law. So every quarter of 2021, you're potentially eligible. How are you eligible? You must have a greater than 20% drop in revenue. So your revenue is 80% of what you would have done compared to 2019. So not compared to 20, which is already down, compared to 2019. Or there's a specific rule that allows you, so for Q1 of 2021, it allows you to look at Q4 of 2020. And if you have a drop there, you can continue to claim that credit when you were eligible in 2020. Now, so we mentioned that, again, the rule is that 20% drop or fully or partially shut down to governmental order. So I know states have done things very differently. Each state has kind of had its own shutdown order or partial shutdown orders. A partial shutdown, believe it or not, is considered if you are unable to get the necessary PPE that you need because of COVID and because of the issues that it's caused and restrictions and those things, you are considered partially shut down because you're not able to actually operate safely. Fully is obvious, like that's when they said, okay, no more dental visits unless it is an emergency, right? So that was the specific ones there. But you'll see with the partial shutdown, there are some opportunities in 2021, even though most practices have really rebounded for the most part from the pandemic. Now we talk about PPP really, I don't even know how much I'll really mention about the first or second round of it, but I think what's most important is to understand that initially Paycheck Protection Round 1, the one that came out in 2020, if you received that, initially you were not eligible to claim the employee retention credit. So it was either claiming the employee retention credit or you took a PPP loan. 95% of who I talked to took the PPP loan. There wasn't even a question because it was cash in your pocket right away. Remember, that had 8 weeks versus 24 weeks. Payroll cost was 75% versus 25%. And then respectively with the 24 weeks, it was 60% or 40%. And so they made those changes to kind of create some more flexibility. We also have this PPP2 now, which has just come out. And again, I'm not going to spend a ton of time on that. The rules have pretty much stayed the same. But the biggest piece, like I mentioned, is how does the interplay happen? So I initially mentioned that if you got PPP, you were not allowed to take ERTC in 2020. The Consolidated Appropriations Act not only extended out ERTC, it also said if you had it, you were eligible to take it in 2020, but you couldn't use dollars for PPP and ERTC. And so for quite some time, for months, we really said, how do we calculate this if we don't know how the interplay with PPP works? We finally got some additional guidance with the Internal Revenue Notice 2021-20. It's about 102 pages of guidance in full. But really what it said is that however you reported information on your PPP forgiveness application was therefore how you could then calculate your employee retention credit. We kind of had hopes of this where they would say, well, just ignore your PPP application. If you have to, you can amend it. They didn't say that. They said, if you've completed your application, it's been accepted and you move towards forgiveness, you have to use the numbers in the same way. So why do I mention that? Well, that's how we look at the utilization of this PPP and the ERTC. So this was in question 49 of that 2021-20 notice. It said that the wages you reported on your PPP application was essentially your election of how you would be using the wages, and then you were therefore not able to use it for ERTC. So using really simple numbers, let's say you had a $100,000 PPP loan. You essentially were able to claim all of it, and many did this. They put $100,000 in line 1 of that application saying, I'm using all wages, because they didn't want to have to provide leases. They didn't want to have to provide all the other information that was needed to substantiate quote unquote other costs. So by doing that, you cannot use $100,000 of wages towards ERTC. So those that haven't filed for round 1 forgiveness, our recommendation at this point is only report 60% of your wages. If you can find 40% of other costs, which are your utilities and rent and things of that sort, if you can find other items, that's 60%. So in the same example, $100,000, $60,000 went to wages, $40,000 in other items. You've just opened up a potential of $40,000 in wages that could be eligible for this credit. So the way the credit works is it starts on March 12th. So any payroll paid on March 12th, and this is cash basis. So if your payroll was paid on March 13th, even though it was for an earlier period, excuse me, you're eligible to take it for ERTC. But it's wages paid after March 12th and before PPP. Those are the easy ones. Those are the obvious ones that those qualify because you don't have any PPP money and you can take the ERTC. So we're seeing a lot of offices claim it. They've got anywhere between 2 to 3 payrolls before they got PPP to really determine, at what point were they eligible for it. Further utilization discussion. So let's talk about a little bit about what happens with that interplay. So, and actually I'm going to go back for a second. So the interplay, again, back to my example, 100% or $100,000 loan. Let's say you've got 5 employees that are eligible and you paid $20,000 in that portion between when you got from March 12th through when you got PPP. So $20,000 across 5 employees. We'll just assume, to keep it simple, they're each at $4,000 to get to that number. So you can claim 50% on that $4,000, and those amounts are eligible. So that's $2,000 per employee right now. You just got $10,000 in credits. That can either be claimed on an amended 941, so your payroll forms. Remember, this is a payroll tax refund. This is not an income tax credit. It is a payroll tax refund. So you would claim it on an amended payroll form, and you would get it as a refund once that payroll form was processed. Now, part of that guidance in 2021-20, that notice said, you can prioritize ERTC in front of PPP. So the most practical way of explaining this is you kind of start at the end of your covered period. So if I'm looking at my loan forgiveness, I'm going to say, I'm going to use the entire 24 weeks. I'm going to try to get my wages to 60%. If I can't do that, I'm going to do whatever I need to do to implement as much of the other costs as possible. And then we can take ERTC on those other credits. Most of the time I've seen this, and so depending on office size, I've seen as little as $15,000 in credits to as much as 40 or 50, 60,000. I mean, there's some big numbers for some of these because of the sheer amount of payroll that's paid, and then this interplay with PPP. So let's say you're one who put 100,000 in line one, 100,000 was your loan amount, it got forgiven. But let's say over your 24-week period, you paid, 200,000 in wages. So what basically we would say, what I would tell you to do is you would go to the end of your covered period, you would apply the 100,000 and work backwards. So let's say your covered period ended at the end of September or the first part of October, which has been pretty normal. You apply the $100,000 and then you work yourself backwards into previous quarters. And then once you've hit that $100,000 point, all the wages prior to that, you're eligible to use for ERTC, assuming you meet the other requirements of being partially or fully shut down or you had the decrease. Why do I say all of them? Is because by working backwards, you've prioritized the first group of wages to be ERTC, which was allowed under that notice. Why would I tell you to do that? Because most practices in the third and fourth quarter were not eligible for this credit because one, they weren't fully or partially shut down. And two, the revenue was no longer down that 50% like it was in Q1, and then also potentially in Q2. And so it's really important to have that interplay. You got to start at the end and work backwards, and then you can see the maximum amount of credits that you can really, really take advantage of. And that's the big one with this ERTC. Most practices haven't claimed it, and we worked through a lot of these calculations over the last few months to make sure that they are getting it, because in many cases we've seen at least 5 to potentially 6 figures on these numbers. Last couple things I would mention with ERTC, and like I said, this is claimed on, for 2020 credits, this has to be claimed on an amended 941. So this is going to be, your Q1, your likely Q2, maybe Q3, depending on your situation, potentially Q4 as well. It really does truly depend on the situation. For 2021, you can claim this in advance if you believe if you're gonna be eligible for it. You can claim it on your 941, and you would get a refund either on your 941, or you can get an offset to a future quarter. And so there's a couple of ways you can do it now that you're aware of it, but in most situations, this is likely you're going to be seeing on the back end, so it's going to be amended. I haven't seen a ton of practices eligible in 2021 because of those two factors we talked about. You've got to have a 20%, and again, now it's the updated 20% drop in revenue and fully or partially shut down. But again, really huge opportunity. I think a lot of practices potentially could be missing out on. But that's it. Those are the things I had for today. And the big important factors, we talked about a couple of miscellaneous credits, a couple of smaller things that are potentially missed, and then a couple of items like the research and development, which, it's there, but again, very specialized. You're going to need help to go through the calculation, understand the differences, and understand how you're eligible or how you're not eligible. And then we talked about ERTC, which has been a brand new one as coming out of this pandemic. Some practices are taking advantage of it, some are not. And so if you aren't, really be aware of how you can claim it, what you need to do, and how the calculation works. So thank you again for your time. I appreciate it, and please reach out if there's any questions.
Wow, thank you, Elliott. That was a lot of great information. We really appreciate you taking the time to share that with us. Our team has received some really great feedback from our clients that currently work with Elliott. So if you have any questions, we encourage you to reach out to him directly at Jones Roth CPA Group. Elliott, thank you again. We look forward to hosting you on another webinar very soon.